Harsha Upadhyaya, CIO Equities at Kotak AMC, joins us on the show right now. And Harsha, morning, not turning out to be the best of mornings, given what the global mood is like, given how our equity markets have been faring off late. What is your sense on how much more weakness one can witness for India?
Good morning. Clearly, we have seen the second quarter earnings being lackluster. That has not really added to any positive sentiments at all. Although the expectations were quite muted, the results were also quite sluggish. So, to that extent, there is nothing locally that's going to help the markets to really show sharp uptrend. As far as global cues are concerned, Japan has once again slipped back into recession, second time in last 3 years. So again, that's a worry. So overall, for the markets, there are no positive cues at this point of time. Only thing is, maybe at lower levels, there will be buying coming in from long-term investors that can offer some bit of support at lower levels.
Harsha, what is the case to buy into India now, or buy into Indian stocks? A year ago, it was hope of economic recovery, hope of government reforms, and assumption that earnings will recover. So I don't think in the next 2 or 3 quarters earnings will recover. Even though oil prices are down, interest rates are come down, corporate India still continues to suffer.
Clearly, Nikunj, it's the same hope that's continuing even today. We expect a little bit better earnings growth for the second half. We were in the camp of 10 to 12% earnings growth when the whole market was looking at about 16 to 18%. Now, I think the entire market is coming down to a level of 8 to 10% earnings growth for this year. That is also dependent on few factors on the commodity side. Nevertheless, I think second half is going to be slightly better than first half in terms of earnings, and that should help markets to at least remain in a range rather than a slide further.
What's your calendar year-end target, Harsha, for the index? I mean, just a month to go before that, but do you see a meaningful recovery from the 7,700 levels that we're currently standing? Or do you think the market in the next 1 month is just going to spend time consolidating at the current levels, if not weaken further?
Our expectation is it's going to be probably range bound in the very short term, and may start to look up sometime in the calendar year 2016. That's what we believe. Although making any predictions on the short term market movements will be really difficult. Nevertheless, I think given the way the markets have corrected from the peak since the beginning of this year, the valuations have corrected quite meaningfully. In the beginning of the year, we were probably at fair value plus kind of valuation zone. Today we are down maybe 12 to 15% from that level. So to that extent, valuations will continue to offer meaningful downside support, and we believe that that's going to keep the markets range bound for some time.
India Bulls housing is down by another 3.5%. So from the recent high, this stock has really taken a cut of about 15% plus. Frankly, markets have zero tolerance for companies where capital allocation becomes a risk and where corporate governance standards are not that strong. So, Harsha, I'm going to come back to you, but I just want to mark these stocks for the benefit of our viewers. India Bull Housing Finance between Friday and today has taken a knock of nearly 15%. Eros has just been a steady one-way slide for Eros, and Amtech Auto and Castech Technologies, you don't want to even go there. Wherever markets just get a sense, whiff, or a buzz that there is a bit of a mismatch, either financially or corporate governance or in terms of balance sheet management, they have zero tolerance right now. Harsha, Indian markets have been polarized, and with each passing day, within sectors also things are getting polarized. 3 years ago, if you bought into IT, pharma and consumer names, you were sorted. That was home run for you. Now within pharma, it is only Lupin which is doing well. Within IT, Infosys is doing better, and the rest of the pack is suffering. So do you worry about the polarized nature or the extreme polarized nature of this market now?
Yes, clearly that's happening. I mean, no more you can take a big sectoral call and get away with it. I think along with top down, you also need to be supplementing that with bottom up research, and within sectors, whether you take automobiles, FMCG, pharma, you name any sector, the results as well as the stock performance have been quite divergent. So to that extent, you need to carefully analyze each company's growth prospects and the valuations, and then take a call rather than a top-down approach. For us, at least in pharma, we were quite negative given the valuation richness in the sector overall, and the underweight positioning there has helped us since, not because of sector specific issues, but because of company specific issues. The stocks have corrected meaningfully, and we were able to insulate our portfolios from that fall because of our concern on the overall valuations in the sector.
But Harsha, what would you do with pharma currently now? Because there has been a significant dip on almost all of those names, large or mid or small cap.
We still continue to remain underweight on the sector. We are not increasing our position in any of the stocks currently. But if they continue to correct further, we may start evaluating them once again at lower valuations.
Okay. What else? Speaking about exporters facing the brunt of selling pressure, Harsha, of late IT has been facing the wrong end of the stick as well. And this was that one sector that I thought did reasonably well in this earnings season too. What's happening here?
I think from our perspective, we were always a bit negative on information technology space. We believe that given the fact that globally there is concern in terms of overall growth, the sector is likely to see quite a bit of headwinds. And also we saw pricing pressure in many of the verticals, although some of the companies did not acknowledge that. But if you looked at the results carefully, that was very visible. So on that account, we were running an underweight position on IT, which has helped us a little bit in this fall.
Okay, that's the view coming in from Harsha on some of the IT as well as pharmaceutical names. But Harsha, you also are bullish on the cement pack. Tell us, why is it that you like the sector and the select names from engineering as well as capital goods? Why is that? Because, we've had the blue chip boys from the capital goods come out and nearly not just half, but more than half their guidance as well. Where and when do you think the signs of recovery are going to come in?
Clearly, if at all, there is some amount of renewed focus that's there in infrastructure sector, wherein the government has started to spend, and also there is quite a bit of order flow that's going in. We believe that the early beneficiary of this upturn in investment cycle, at least in the infrastructure, especially the road projects, will be for cement companies. And this is also a sector which has quite a bit of excess capacity. So as the volumes pick up, if there is pricing power, and which we believe is going to be there, the profitability can move up much more significantly than the top line. And that's the reason why we are bullish on cement. Although the results have not really shown that kind of numbers, it's been quite patchy. But we believe as the volumes pick up, there is going to be meaningful upside in this segment.
Harsha, so good chatting with you. Thanks much for taking the time out and speaking with us today.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.